A weak jobs report last week gave investors hope that the Fed might slow any rate hike decisions. However, with the US-Iran standoff hurting energy markets, this week's inflation data is likely the bigger decision maker. Let's take a look. First, last week's July jobs report. The good news, unemployment unexpectedly fell in July. However, payrolls whiffed, losing 23,000 jobs compared to expectations for an 83,000 gain. It was even worse when you factor in the downward revisions. Including the May and June updates, July was net down 126,000 jobs. It was a very weak report, but markets cheered anyways. They were hoping for a weakening labor market that would force the Fed to hold off on future rate hikes. Now focus flips to inflation this week. On Wednesday, we get the July CPI. Economists expect the headline consumer inflation to slightly rise, with the core metric rising a little more. Then Thursday, July PPI lands. Producer costs are expected to rise a bit too, with the core metric also higher. So what's the deal? Well, we can see why markets are comfortable with the weaker labor market for now. If inflation lands in line with expectations, we're looking at minimal inflation and a weaker case for rate hikes. However, the US-Iran standoff is the elephant in the room. Crude oil prices spiked 22% in July. While it may not show up fully in July, it's still likely to pressure the August numbers, especially with no reopening of the strait in sight. Markets may optimistically rise on inline or better data, but that may be short-lived. We could see worse data accelerating rate hike fears. We'll see starting Wednesday. Stay tuned.